Hello, friends. Once again, I welcome you back. So I'm here with episode two, and yesterday we started on some video series where actually I'm looking for that. I codenamed them the institutional perspective, the institutional point of view. So basically, in this series, you can even check out. I created a playlist. You get. So this is episode two. In this. In these upcoming videos, I don't know how many there will be. Most likely there will be 20. I'll be sharing some of the information personally that I believe in, that is behind some market moves that happen. So basically it will help us when something is happening, for us to understand why it's happening and to anticipate what may come in future, because basically in trading we base on what is given. We base on history to determine our entries, either to buy or to sell. You get. But as I told you, you can only be successful in a business where you understand, which you understand the best. You get. If at all you just place entries and then you're profitable, good luck to you, because it's just luck. I don't know whether it will be consistent, but in the market you have to be knowing what you're doing. So basically this is episode two, and yesterday we were talking about consolidations and then these impulse moves that happen. That happen. So basically that's what we were looking at. So in later episodes, we shall be talking about how to deal with the ranges a bit more, and how to deal with these displacements a little bit more. So I told you here they create fear, and here they create greed. You get. So here you fear, and then here you get greedy. And then one of the most important things, I told you how some of the candles form. For a bearish candle, for most times they create fear. Most times, or they may create fear through a consolidation. You get. Then they create greed, and then they end into fear. Basically this is like the cycle. You get. So this is a bearish move. We start in a consolidation, we get a displacement, then we get those moves. So basically sometimes you are in a state where you don't understand when to get in, when to get out. But I told you, if at all the purpose here is to create fear, then we shouldn't fear. And then here, when they're displacing, it's always good that to be part of the displacement as it's starting, because later on sometimes it could be tricky for you to jump onto the displacement, though it's also possible depending on the time frame that you are on. So today we are going to be talking about what we call imbalance. You get. So this today's topic is about imbalance. If I can write it well, balance. This is episode two. You get. So imbalance, basically that's what we are going to be talking about. Imbalance in the market. You get. So basically, if I even before I proceed, in the market, when we are consolidating, all these moves that are happening like this, sometimes it could even be a sideways consolidation, where no fairly, not exactly sideways, but when generally the market is moving like this. So we could say that here the market is also ranging as it's coming down. You get. So basically the ranging market, most when you're going sideways, we could say that here the market is balanced, because we're having buyers and sellers, buyers and sellers, buyers and sellers. So basically the market is just moving up and down, so here it's balanced. But then later on we can see that we get displacements in the market. We get displacements in the market. Now if at all this is a business of either you lose or you win or lose, I told you we have no physical products over here. So which means whoever those institutions, if at all, actually I gave you a picture. If you Google, I Googled it, and then I found that currently it's like about $6 trillion daily trading volume. So which means if you're coming with an account of even 100,000 US dollars, it's it's a very, very small proportion to 6 trillion. You get. Much as those 6 trillions are not following into one currency pair or gold or what, still it's a significant amount of money. It's very, very significant, truly. So which means you have to be willing, or you have to make sure that you do proper analysis, so that you be part of the points when the market is if you're buying at the point of the market when it's in demand, and you to be selling at a point when the market is in supply, you get, where in the supply areas. So we shall be seeing that all that in future, you get. So basically, for a ranging market, why wouldn't we get a balanced market, or for almost entirely? Why would the market have an imbalance? You get, these are some of the reasons. If the market was ranging like this, you get, it could also provide opportunities to some people. This is a 1 hour time frame. Let's say someone, let's say the market starts here, it reaches here, it bounces back, it comes down. So it could be easy for someone who is even just new to trading to take an entry here, and then they think this is my take profit, you get, and then they reach here, they sell, you get. So if at all the market was just ranging, let's say sideways, they get, like this, like this, it would also provide free money to some people who are not even doing enough work, you get. So it wouldn't be profitable. That's why uh, they create these consolidations, and that's why I told you I like them, you get, as long as they are not taking so long. And it was one of the controversies that I had over synthetic indices, sometimes, not always, because I trade them. And I'm also going to be illustrating using them also in this video, because in these videos, most of the time we are going to be showing an illustration in forex and synthetic indices, because I do them both. So basically, if at all we get this consolidation, it gives a break to understand where the market is likely to go. So later on, these institutions increase volume, like they start displacing the market. We get a displacement in the market where the market starts to move, you get. And then you're going to find that most of the time, one of the things that we're going to be getting is what we call imbalance in the market, you get, whereby most of the time it's we are going to be signifying it mostly if at all we get a large impulse candle, you get, very large, you get, a very large candle. For instance, let me show you one example. You see this candle just over, you get, this candle over here. So this is an imbalance in the market. It is fairly, it's like 2.5 times the size of the average candles that you're seeing here, you get. Most of the candles, it's like 2.5 the size, you get, more than the size of the average candles. So even this candle that you're seeing, it is, so here we get an imbalance, you get, this is an imbalance. We have even other imbalances. Sometimes it's going to be signified by, at least if at all it's a bearish move, when we get about 3 candles, 1 2 3, but here we have 4. So basically in these regions, we are going to be categorizing them as regions of imbalance, you get, regions of imbalance, you get. So which means this is the balanced area, you get. Or even during consolidations, the market we could say that it's in an imbalance sometimes, if at all we are getting large impulses. But if the market feels right away, then we can say that overall in this region the market is balanced, you get. And then these large impulses, so what are the opportunities? I told you we cannot consolidate forever. Besides, it will scare off people. If I told the market was rugged, you get, it will scare off many retail traders from not trading. So basically, if here they are creating greed, you get excited on getting on. But remember, almost each bearish candle is almost starting this way, you get, and then it closes like that. So you're getting lost in when to get in. You first think that you're buying, they sell, and then they close buying. They go in a consolidation. So you get lost, but then you feel the market is moving. You should be part of it, you get. So that's what we want to overcome. So basically, what do imbalances signify to us? Given that we are basing on history to determine our entries, we are going to be using them to anticipate, you get, to anticipate, and even to know when the market, the stage of the market that we are in, you get. Are we in a consolidation? Actually, here, this is what we call liquidity zones. These are going to be the liquidity zones, you get. These are the liquidity zones, because if it is liquidity, these are the points where the market is gathering the fuel. Basically, if at all you want to move the market, you need money, you get. Here you need money. It's a lot of money to determine the direction of the market. That's why here they consolidate people lose a lot of money here. They gather enough money for them to start moving the market to a given point. You get to give to a given point. So that's why we say these points are necessary in the market, because we know when they happen, when they do happen, time is going to come when we shall be moving. Here they gather liquidity, and now here they move the market. You get, they move the market. So now when we start getting these displacements, you get these displacements, and the imbalance, you get these imbalances. We start to anticipate that the market will be coming back in those regions to fill up those imbalances. You get, so when we get shifts in market structure, you get, these could be some of our targets to hit. You get, they become some of our targets to hit. You get, so I've given some of the reasons, and I told you, for me personally, that's why in my classes I always tell my students that we take entries with a reason. You get, and I believe at least here we are not gambling. We are having a reason behind our entry. If at all we are taking, let's say, a bullish. Actually, later on there's something I will be analyzing for you in later videos about here, where we would get in on this point, possibly, if at all we came on the charts and the market was coming here. So if at all I got in here, this would be an opportunity for me to be part of, let's say, coming back to this point. You get, so you scalp off and then you take your profit here. But then we find that maybe personally for gold, this was the target, and you can see that we are in our selling zone. You get, so let me not skip a lot of spaces. Let me explain the imbalance. So basically I told you imbalance comes after, it comes when, most of the time, after, out of consolidations, when we are getting a displacement from one point to another. So we are leaving this point, you get, we are leaving this region to another region. You get, so now there are many. So let me show you an example, maybe on synthetic indices. This is a jump 25 index. You get, this is jump 25 index. You can see that we have an imbalance just from this point, almost the whole of this region, because we can see that buyers barely participated in this market. You get, so we can call this an imbalance. You get, because it's an impulse move. You get, yes, not all imbalances. Why am I bringing on this jump 25 index? Not all imbalances, they're going to be arising immediately out of consolidations. You get, so we need to analyze that. But you can see that previously we had a little bit of consolidations. You get, a little bit of a consolidation or a consolidated move. You can see that. So anyway, I'll be going through that in the later videos. But then not all imbalances are just immediately, they're not always immediately out of consolidations. But when they do happen, we can expect double moves, double opposite moves. You get, moves up and moves down. You get, so that's it. So then there is something that there's something that I want to bring out. You get, now there are those imbalances that happen at a break of market structure. We've first seen these imbalances, an imbalance that happened out of a consolidation. You get, out of a consolidation. But then there are these imbalances that we do get. You get, that we do get after, at a break of market structure. You get, and these are the imbalances that I used to talk about mostly. That's why even we are going to find that there are many types of order blocks. There is someone, I'm yet to receive a call from him on Telegram. He was telling me that he's been using order blocks, but he's finding challenge and he's losing. So there are many types of order blocks, and they all signify different things. But now I want to talk about the imbalance that arises out of at the break of market structure. You get, and these are the imbalances that I used to talk about mostly on this channel. You get, whereby you can see that the market was moving, and then we got a shift in market structure. So when we break structure here, when we broke structure here, and then you can see that really we are having only sellers participating. We can see this is a very large displacement. This is a very large displacement. So now, at the back of our minds, we start to think that at one moment, you get, when we start getting bullish confirmations, we buy, and then at least this one becomes our target. You get, and then this one becomes our target. Why? It's because we want to fill up the gaps that have been left behind. You get, we want to fill up those gaps that have been left behind. You get, so now that's why uh, so this is what we call a return to origin. We return to the origin where the imbalance started, and then you can see by the if we had to go to my MT5, this is the setup. That's why here I got this confirmation when we came to this point, selling to down these areas. You get, so these are the opportunities that are being provided. But then let me first show you. So which means when we got bullish confirmations, of which I'll be showing you an order block here, and then the entry confirmations that are used. So here you can see that the market came back in that zone, and then what was the signal? It was to sell. You get? So it provided an opportunity at least to sell from this point to down. But then it was also providing an opportunity, if you came onto the charts, buying from these points. You get? From these points, from this point up to this point, and then it will provide you with an opportunity for you to sell from this point to coming back down. You get? But you know, we are not going to range forever. The market is not going to be providing us with perfect opportunity, perfect points. Let's say it comes down, it reaches here, it comes up, and then we come back exactly here. No, you get, and we shall be seeing all that. We shall be seeing all that. So at least the first opportunity, that those imbalances that happen at the break of market structure, like when we get a shift in market structure, you get from, let's say, bullish to bearish or bearish to bullish. You get, so that's the first opportunity. Then the next opportunity that I want us to look at, there is something that I really want to explain to you. And here, let me come to this platform. So there is something this is the US 30. You get, this is, so sorry, I was interrupted just a little bit. I'll see whether I'll be able to cut out that part. So what I was trying to say is that this is the US 30, and then you can see, actually this was the time when we got a new release, and I think the CPI. You get, so basically we were getting some kind of a range, but we are going upwards. You get, we are going upwards. But what I'm interested in is that is this imbalance that we have over here. This was as a result of the news. You get, so now, all in all, whatever the cause, given that we know that when you get an imbalance, we start to anticipate a shift in market structure where we shall be returning to this point. The market makers know that. You get? They know that. Let me give you a simple trick, and you try to backtest this. Is that most of the time when we get an imbalance, and then we get a sideways consolidation, it is a sign that the market intends to extend a little bit more before we get back to this point. You get, it may continue, let's say, in that direction before we return to this point. So here for you, when you start seeing a slowdown in the market, in the momentum, some people will start to buy here because they know we are coming to fill up the imbalance. But it is not a confirmed it is a confirmed principle, but it is a theory. Take it from me. Most of the time when we get a sideways consolidation after an imbalance, it is one of the signs of the unwillingness of the market to return back to this point immediately. So which means, personally here, my bias is inclined towards selling more. You get? Or if I was holding my entries, it is to hold them more because I know we are proceeding. At least we may retrace back just a little bit. You get? Just a little bit, maybe to this point. You get to this point, or to these points, but then we proceed down. At least not exactly here. You get? So take that from me. So we can see even on US card, I think there's something I wanted to say here. Yeah. there are those moments when we get a break of a shift in market structure. The market will break a structure here. So what we know is that we can see that we left with an imbalance, only bearish candles. This is USD CAD. And then you can see one of the things that we anticipate is to come back to the point. So there are those moments when we return immediately. So this return, at least sometimes you just have to be patient. We would come here, and then if we return here, we will sell because we were intending to sell. You get? So these are the imbalances that happen at that arise from a break of structure. You get? This is gold. You can see we had some large displacements. We were out of a consolidation. We get displacements, and then we get a sideways consolidation, which was intending that the market intends to proceed a little bit more. You get? So these are things that I wanted to bring out. Peace.